Are you ready for more financial modeling in Excel? Hi, I'm Brian Amrine with Value Driven Analytics, and in this video, we'll pick up from where we left off in part 2 and continue our financial modeling. In this session, we're going to copy the work that we created to create an income statement and a balance sheet for the company's current scenario that we're looking at, and use that to start a balance sheet and income statement for this investment scenario that an investment banker might propose to this company, so that in the end we can compare our income statement and our projected balance sheet if the company were to make an investment versus not. Along the way, we'll learn several Excel data manipulation functions. If that sounds good to you, let's head over to Excel. Now I think we're ready to create our with investment scenario. Now a good place to start, we've done all this work to link all the cells together like they ought to be for an income statement versus a balance sheet. Let's go ahead and copy this entire section. We're gonna have to keep an eye on formula references when we do this. I'll go a few cells over, paste. I didn't do paste values. I want to keep the cell formulas in this case, and I'm going to call this our change scenario, or I guess our investment scenario. Alright, let's take a look at what happened here. I just noticed this as I was copying. We probably want to widen column M, and we want to keep all the columns the same width, so we'll highlight all of the columns, just right click a little bit until we see those hashtags kind of go away. I suppose it's a good thing that by 2032 we expect our assets to grow in the millions. But there we go. Now we don't get that cut off anymore. Clearly there's something up over here. Probably didn't lock in cells like we were supposed to for certain ones. So let's see what happened here. I'm going to double click into sales, see what that's referencing. That was probably the issue. Yes, we did not lock in the sales reference, so we'll just go ahead and drag it over for now. And that way our starting balance is locked in. Very good. That took care of a lot of things, it looks like. Yeah, this is still referencing column D for cost of goods sold, gross profit, just still the difference between those two. Selling and general it's still referring to that same percentage in column D. Yeah, everything in the income statement is, oh, interest earned, there we go. Okay, so we're still referencing column D, but now we're referencing a cash balance of 0. So that's probably a reflection of the starting cash balance. We'll need to repoint that eventually. Same thing with debt, most likely. This formula looks fine, still referencing the same tax rate in column D, and income is a simple calculation. It drug over just fine. Go down to the current assets. Well, that formula looks good, but our cash, yes, our cash, the column moved over to column R. We could have locked this in perhaps. We'll just want to update that. Our starting cash reference to come over here to our 150,000. Good. Same thing with that one. Let's see, I think we can drag this down. Yep. And then similar with, yeah, fixed assets, formula looks good there. Land, same issue as cash, needs to be drug over. We could have locked that one in. Land. We should be able to drag that down now. Good. These assets, some of current assets, fixed assets, that looks good. Looks like we ran into the same issue with current liabilities. Wished I would have locked everything in before moving it over. But we'll fix that now. And then debt needs to be updated too, brought back to column D. There we go, it's looking good. Okay, paid in capital, that's another one that needs to be brought over. Really important to perform checks like we are right now. 361. You know, and a good check to make sure we didn't miss anything is just to check and see that, oh, yeah, our assets are the same. Now we've been focusing on 2023 for now. Let's kind of scroll to the right and maybe we check this 1.037 thousand, 1,037,000 number. Now, these are getting cut off over here too, so we'll do the same thing. Highlight the columns, drag to the right a little bit. Yes, that matches. I'm looking at 2032 after we've had all these years of sales growth and everything, assumed sales growth, and we're still getting the same balance. That's great, because right now we haven't really changed anything, but our model's set up. It's the links are there for our investment scenario, and so this is really good. We haven't changed anything. The investment scenario column matches the no change scenario. Now we're going to actually make some assumptions and change some things. And so we're going to, write a few parameters here too, because maybe we're not sure how much this company's going to cost, and we want to get a sense for what the impact on our income statement and balance sheet would be at different investment levels, depending on what we pay for this company. So one of our inputs from an investment perspective, again, we're using a lot. You can see we're already using a lot of our starting parameters over here that are not necessarily going to change whether or not we make this investment. But there are some parameters that are going to be specific to the investment scenario, and so we'll mark those on this right side where we have the investment scenario. And the big one is going to be how much do we pay for it? What's the cost of the investment? And so we will start that at let's say 500,000, and we'll be able to adjust that if we want to and see what the impact is. Cost of investment. Now eventually we're going to have to think about how that gets allocated on our balance sheet. Let's say for this scenario that we're planning on financing that 500,000. This investment banker comes and they say, we can help you get a loan for that 500,000. It'll just be additional debt, but man, it's going to be fine. You're going to be able to pay it off eventually because of all the revenue you're going to make. And so in the long term, it's going to be a good thing. That's the investment banker, let's say. Let me adjust this. And so if that's the case, then down here for our debt, what we'll do is say, okay, this equals actually what it did before, our starting debt, what it would have been, but now it's going to be that plus the cost of the company. There we go. All right, I'm going to move this over a little bit so cost of investment doesn't get cut off. Great, and we'll color this yellow. Now what we need to figure out is, okay, if your debt's going to go up, then your assets need to go up. So we need to figure out, okay, I paid 500,000 for something. What did I get for that? Let's just say the company, let's just say we say we got 250,000 worth of land, and we got 250,000 worth of equipment, and that's how this 500,000 is going to be allocated. Okay, so what we might do is say percentage of investment allocated to land, percentage of investment allocated to equipment. And we'll say it's 50-50 in this case. So about 250,000 allocated to each one. Let's see. All right, so here's our land. We're going to say whatever our land would have been, the 200,000, but now we're going to add to that the cost of the investment times 50%, the percentage allocated to land. And likewise, our equipment will be the 100,000 that we had originally plus cost of the investment times the percentage allocated to equipment. And so now, after buying it, we would have 450,000 in land, 350,000 in equipment. There we go. Looks good. We've got that parameterized. Oh, so if we want to update it later, we can. Now, let's say that as a result of buying this, we're going to expect higher sales. That would make sense. We're selling putters now. That's part of the purpose of buying it. Now, let's say that we could do it from a percentage perspective. Let's say we expect an initial boost in 2023 when we buy the company. We're kind of assuming we buy it at the beginning of the year. Let's say we expect a boost of 125,000 in sales. That's our expectation. So see, impact, starting impact on sales. Again, we could do it from a percentage perspective. We'll say we expect to now have 125,000 more sales. That's about what the putting company was doing per year going into this. And we think there's some synergy here. We think that combining all of the putting and the driver, the total impact that'll have on our cost is it's going to reduce our cost of goods sold by 5%. So we need to factor that in as well. Impact to cost of goods sold. And the cool thing about this is if we want to update these and say, well, what would it be if we didn't assume that? We didn't make that assumption that it was going to lower our cost. We can change this to 0 and see how the model updates. All right, let's bake that in. So 125,000 is our starting impact on sales. So we would simply come down here. Right now it's referring to a starting sales in a no change scenario. We want to add to that this 125,000 that we get from the putter sales if we buy that company. Great. Now notice the rest of it, we're going to assume that 4% increase we were assuming before on our legacy sales as well as the putting sales now, and it goes up from there. So we are assuming that 4% on all sales with the putter sales included here. Then on our cost of goods sold here, we've got the sales. And I guess in this scenario, we're assuming that that the putting company too had a 40% gross margin. We're subtracting out that cost of goods sold or that profit margin to get the 60%. But now we're actually saying that our costs are going to be 5% lower. And so we can come up here and subtract out that 5%. That will only help. Yeah, should have brought it down. Actually, I think we need to do, yeah, the impact is -5, so we need to add that. Always good to check your work and make sure it goes in the direction you thought it would. Oh boy. Okay, here we go. Okay, 1 minus 40%, add this, and it brings it down. Yes. Okay, good. So our cost of goods sold does indeed go down after factoring this impact to cost of goods sold, bringing it down by 5%. Okay, now we might need to, let's see if we need to drag things over here. Yes, this is one we'd want to drag over. It's consistently referencing sales. Before we do, we need to lock in the impact of cost of goods sold. That in, drag it across. Great. Okay. Well, let's just do a few checks here. Okay, so we updated our sales. We updated our cost of goods sold. Gross profit is still going to be the difference between sales and cost of goods sold. Selling, general, and administrative expenses. That is, we're going to assume that we pay the same 15% on our sales, even with the putter sales. And then earnings before taxes and actually that is something we might consider, is maybe we think we can keep about the same level of selling, general, administrative with the new company. You never know, but just different assumptions we can think about. And I just realized that these are not all centered. There we go. So I'd like them to be. Okay, coming back to our formulas. Yeah, earnings before taxes and interest still going to be gross profit minus our selling, general, administrative cost. So that looks good. Interest earned. Okay, let's see what happens here. And this is part of where the analysis would come in. Just kind of look at it, especially for, yeah, notice in year 2025 it's a little different now. It's higher. The interest earned is higher. Let's go down here. We're referencing a higher cash balance here, so we expected our cash to go up in the year 2024. All right, now eventually we're going to go down to cash and kind of see if that amount still makes sense. Why would cash have gone up here? Well, let's come down here. Cash is really kind of a reflection of how much you earned. So our earnings, yes, we did expect more earnings in the first year, 2023, with the new scenario. We expected 43,000 instead of the 38,000. So that's about a $5,000 difference, which is also reflected up here. Why? How did we get this difference? Well, now we can kind of compare this 2023. We have 325,000 sales instead of the 200,000. Now our costs are higher, but you can see even after taking into account the cost, our gross profit is higher. Even after accounting for the selling, general, administrative, 15% of sales, our earnings before taxes and interest is higher. Then our interest earned is about the same. Ooh, look at this. Our if we didn't have to finance that, if we didn't have the big increase in interest paid because of, remember what this represents, it's that debt. Now it's 600,000 times the 8% instead of the 100,000 times the 5%. But what we're finding here is even after accounting for that higher debt service payment, this 48,000 versus the 8,000, 40,000 more in interest we're paying on that 500,000 that we borrowed to buy the company times the 8%. We're finding that the revenue that we got, or saw an expectation, we offset that, and then we're paying a little more in taxes because the earnings are a little higher. And at the end of the day, even in year one with that higher debt, we are making 43,000 instead of the 38,000. All right, very interesting. And so that allows us to coming back to, I think, interest earned here. We are starting to build up our cash balance by making more, which gets us more interest earned eventually too. All right. And we're consistently paying more on our interest paid, right there. At this point, there hasn't been an assumption of paying back that loan at a certain point. But let's keep going here. So we have our taxes that fluctuate. It's always a reflection of what our earnings before taxes and interest our interest earned and interest paid were. And then coming down here, our current assets is always a sum of our three line items, which makes sense. We're not assuming any changes in accounts receivable or inventory. We assume this land and equipment purchase, that was relatively constant. It increased when we bought the putting company and stayed flat from there. Same thing with depreciation. So our whole fixed assets is staying pretty constant. And our total assets is just similar to what it was in the no change scenario, just a reflection of our cash going up over time. Let's come back to that. Liabilities, we are assuming our current liabilities didn't really change, similar to the no change scenario, but our debt, instead of being 100,000, is 600,000, and that is linked to the cost that we paid for the company up here. So if we change that at the top, we can see how that would change below. Very good. And our total liabilities stay pretty constant. Same thing with paid in capital, not assuming that we're adding anything to the business. I guess we could have assumed that instead of financing it via debt, by increasing our debt here by 500,000, that we actually paid in more capital. That would be another way to finance it. But in this case, we didn't pay in anymore. We're not taking out anymore. And we do see that our retained earnings is growing over time. And that's a reflection. It's actually growing more. If you notice here, our retained earnings in the year 2032 is higher than it was in the no change scenario. So we've got that captured there. Current year earnings, yep, that's higher. We saw that in the income statement. And our total equity, that has increased as well. And let's do that classic accounting check. Yes, our assets equal our liabilities plus equity. Very good. So we're kind of building up our cash balance here. We're able to build up some cash, and so what we might be able to do is we might be able to eventually take some cash and pay off that debt, so we don't have to pay that 8% interest rate anymore. Lots of considerations we want to consider. You know, can we invest that 8% and earn more than that 8%? That would determine on when we and how we would want to pay down that debt at a certain point. But an investment banker might now be able to point and say, here's what your income statement looks like today if you don't do anything. Here's what it would look like if you bought that putting company. For this scenario, there are a couple of selling points for the company to do this thing, and they would call this a leverage buyout because we're taking on debt to finance buying of a company. It's called a leverage buyout. But one selling point might be the fact that if we look 10 years from now at 2032, what we forecast to happen if in the no change scenario versus the investment scenario, our equity, again, assets equals liabilities plus equity. So another way of thinking about equity could be if you took our assets in this section, in the no change scenario, our assets would be this 1 million or so. If we took those assets and we'd have to assume that this amount really represents what we could get out of it, and maybe that's maybe we need to reconsider that and think about depreciation and everything. But if we were to take those assets, subtract out all the money that we owe, accounts payable, deferred income, debt, we would be left with an equity amount. And you can see that the equity is assumed to go up. It'll go. We assume that the total equity goes up from 922,000 is what we would expect to have 2032, 10 years from now. Without the change, we'd expect to have 1,063,000. So it goes up by, and we could actually copy and paste this whole table again and do the difference between the no change scenario and the change scenario year by year, and actually have a table that shows us what the forecasted difference would be for each balance sheet category for each forecasted year, and of course the income statement items as well. what would the true change be for doing this versus not? That might be worthwhile. But in this case, we just did this very quickly and said in 2032, our total equity, we expect that to be 141,000. So yes, you're taking on some more debt. Yes, that debt has 8% interest rate that you're going to have to pay year after year. But the revenue that you're getting, the cost savings that you're getting, is worth it. And again, this kind of assumes that we took that 500,000. We assumed that we were really getting 250,000 in land, 250,000 in equipment and everything, and so that's part of it too. If we didn't actually get that, if we were to sell this whole company at a certain point, and liquidate it, we would you know we would need to get those same values in order for this 141,000 to kind of hold true. So that's one way of kind of thinking about it at a very high level. Another route we might want to think about it from is it's not like a liquidating the company perspective, hopefully not thinking about that, but another route might be, well, eventually we want to take this money, that we've made, this additional cash that we're seeing. So another look at it is, hey, your cash is going to increase. It's going to go from 647,000 estimated in 2032 to this 788,000 in 2032 if you buy the putting company. So you're going to have 141,000 more in cash, and you could use that cash to pay down the debt. And so maybe they get to a point, just being very conservative about this decision, and say, well, yeah, if 10 years from now we've earned enough cash to pay off the company, sure, we can do that. So at this point, if we were to say, well, we want to pay off that company in 2032, what we could do is say, okay, in 2032, our debt, I'm going to highlight this cell right here, we're going to subtract whatever we paid for the investment. Let's say this loan, kind of what we're assuming here is that the loan, it was just an interest-only loan, and so each year you saw the interest paid went up in the investment scenario. So we're paying that 8% on the 500,000. Let's say that balance holds true, and then at the end of 10 years, we're going to pay this off. So we subtract that. We're back down to the 100,000 that we were at without the investment. In 2032, we pay that off, and notice because of the way we've set up our cash is any of the changes that we make has an impact on cash. So what that would do to our cash balance in 2032 is bring it down to 319,000. And so it's lower than what it would be without the investment. But again, we have gained all of this. Hypothetically, we've gained land, right? We've gained 250,000 in land, 250,000 in equipment, assuming we can sell it for that, and our sales are operating at a higher level, and so we might continue to expect to get this higher net income that we've been observing. All right, so what we might want to do from there is say, oh, well, I'm just not, I get it. We still have higher equity to the tune of about 150,000 under this, because we can, if we were to liquidate the company, that would be our leftover amount in equity. But I really want to have the same cash balance in 2032 as I would without investing in this company. So they could say, okay, well, what if we invested, instead of the 500,000, let's say we invested 400,000. And now we can kind of compare and say, okay, that's a little better. Our cash only goes down, our projected cash for 2032, it goes down by 170,000. What if we invested 300,000? Now notice, you might think, well man, you pay 100,000 less for it. Your cash balance then would be impacted by 100,000 less. Well, there's a lot more going on here. That invested amount impacts the interest that you're paying year after year after year, several other things as well. And so it's not as simple as just saying, well, if we pay 100,000 less, we'll we'll have 100,000 more in cash at the end of 2032. Watch what happens if we pay 100,000 less than the 400,000 now. We'll pay 300,000 for the company. Now our projected cash delta goes from being down 170,000 to just being down about 11,000, which is fairly flat here. And that's because by paying less year after year after year, we were also paying less in interest too. And other aspects are probably changing here too. So if we can get this company for 300,000, and we could be a little bit more precise and maybe do, I don't know, 290,000 if we wanted to get this really close to zero. Okay, we pay 290,000. By 2032, we would actually project that our cash is the same level we had before, but our equity is significantly higher because we've gained all that land and we've gained the property and let's see, what did we say, the equipment and the land has gone up by 500,000, and our sales are operating, our net income now by the year 2032 is operating at a 45,000 or so net income each year instead of 24,000 per year. It's almost doubled our net income. And so, or I was looking at taxes, sorry about that. But actually, even if we look at the net income, our net income has gone from 134,000 to from 73,000 projected for 2032 to 134,000. That's a huge increase, and we probably project that we could continue the projections here, project that continues to be the case, and in 10 years we're able to pay off that loan, the debt's gone, and our cash is the same. So maybe that's too rosy, maybe it's not, but at this point the investment banker is able to quickly adjust assumptions and say, well, how about this? Would you feel comfortable with this level of investment? And they can make the offer to that putting company, see what happens from there. Hopefully you've enjoyed this as much as I have. It's really a great example of the way an investment banker or a company's investment team might consider a potential acquisition. All right, if you choose to accept it, I've got some homework assignments for you that you can use to reinforce the concepts that we've talked about today. The first one involves starting with our personal finance workbook. You can use the one that you've developed if you've created one alongside the training, or you can go to our website, check the description for the link, and download the workbook that I created there. And take that workbook, and on the second tab, create a second tab, and there we want to do a monthly breakdown, and we want to point it back to our first tab, our annual breakdown, so that if we ever update our annual budget, it would automatically flow through to the second tab. And it'll be broken down by month so that after each month we can actually assess, one, what our budget is, so make sure that it's by month what's your budgeted income and expenses. But what we want to do now is actually add in a column next to it, or at least some method of comparing what your budgeted amount was for each month to what your actual spend is. So come up with a second tab, breaks down your budget by month, and allows you to actually assess how you did that month in terms of income and in terms of expenses against what your forecast was. Love to see what you come up with, and maybe you can share a little bit about what you come up with in the comment section of this video. In the college football use case, we saw that the constant represented the impact of being the home team on the home team's point differential against the away team, but that was just for the postseason games. What I'd like for you to do is calculate that impact of being the home team on the home team's point differential, but for all games, not just the postseason games. So try to do that and let us know how it goes in the comment section. All right, last homework assignment, and this one also uses the college football games workbook. In the demo, we looked at the relationship between a simple winning percentage in the regular season and a team's postseason performance, and found there to be somewhat of a correlation. What I'd like for you to do is create a metric that assesses a team's regular season performance but in a way that adjusts for that team's strength of schedule during the regular season. And then see if that metric that you create has a stronger or weaker correlation with the team's postseason performance than simply using the regular season winning percentage. We'd love to hear what you come up with in the comment section. I want to thank you for watching today. I know it's a time investment, but I hope you got a lot out of it. And if you did, please consider giving this video a like, and we hope we'll see you at our session 3 in the series on Power BI. Now, if you want to get notifications on when new videos like that one come available, please subscribe to our Value Driven Analytics channel. And let us know if Value Driven Analytics can help your organization with anything analytics related. Check out our website, valuedrivenanalytics.com, and if you're interested, give us a call, 1-877-825-3786 or 1-877-VAL-DRVN. We would love to talk to you.